Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about planning for your retirement income and some of the key factors, actually 5 key retirement factors that you need to be mindful of as you begin planning for retirement. In particular, if you're within 5 years of retirement or even retired, you'll find these factors really important as you begin to plan your retirement journey. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time, quite literally on all aspects of retirement. And so hit the subscribe button so you don't miss our future content. As well, if you like the video, click like. Now, when planning your retirement income, one of the first factors you need to take into account is longevity or longevity risk. Potentially your capital or your income needs to last a long time. Let me share a few stats that might surprise some of you. So if you're a male age 65 in reasonably good health, there's a 50% chance that you'll live until age 84, and there's a 25% chance that you could live to age 90. So often, men can be a little bit cynical about how long they're going to live, but there's a pretty good chance of living well into your 80s. For women age 65, again in reasonably good health at that point, there's a 50% chance of living to at least age 88, and there's a 25% chance of living until age 93, so a little bit longer than those men. Now, in a couple situation where you're both, let's say, age 65, one person has a 50% chance of living to at least age 91, and one person has a 25% chance of living to at least age 95. So as you can see, for many people when they're planning out their retirement, they have to factor in when they're doing the analysis and the number crunching and modeling cash flows. You shouldn't be using age 80 or age 85. You should be using age 90, 95 in many situations to bulletproof your planning in terms of long-term retirement income. Now, the second component to retirement income planning, the second factor is really your asset mix or your asset allocation investment strategy for your portfolio. There's probably 3 main portfolio mixes you need to be mindful of. So the first one would be the accumulation stage. So while you're not retired, while you're in your 20s and 30s and 40s and starting to save for retirement, you're basically focusing on longer term investment horizons, focused on investment vehicles typically tied to equities or the stock market to try to get above average returns over time. So generally speaking, your portfolio should be more aggressive, have more stock components to it to get those higher returns. Now, the next phase is what we call the transition phase. And so that's where you have conflicting needs. You still want growth. You still have a lot of years ahead of you, but you want to become increasingly cautious because you're getting closer and closer to the point when you may need to take income from your portfolio. So you're beginning to think about this transition into your early 50s to mid 50s, where you begin to move that portfolio from more of a growth or stock portfolio to a portfolio that has a mix of more cautious, safe harbor, safe haven assets that will be there ready for you when you need to produce income. And again, your retirement income plan will give you guidance as to what percentage of your portfolio needs to be in safe harbor as you get closer to your retirement portfolio. And then when you get to the third phase, you're now in income. And so the income phase is about capital preservation. It's also conditional around dealing with longevity risk. And the objective should be to reduce risk and capital loss as much as possible, while at the same time trying to get satisfying investment returns that will help you cope with the negatives of inflation and taxes over time. It's a real challenging time for investors who are either getting close to retirement or retired right now because interest rates have been so low on safe harbor assets. So there's a lot of strategies you can use to try to get a better return to compensate for the low yields in the bond market, while at the same time not exposing yourself to too much risk. We have a video that talks about the income wedge strategy, where as you initiate your retirement income planning, that plan will give you guidance as to how much money needs to be in your portfolio at the ready the first 2, 3, 4 years of retirement. That has to be safe harbor. Money that doesn't need to be used in 5 or 6 or 7 years, you can take more of a balanced portfolio strategy, and money that doesn't have to be delivered to you, let's say for a decade, you can be more growth orientated. So it has to be a much more nuanced, much more tactical approach to your portfolio when you get into the income phase. Now, another really important component, is really factor number 3, is dealing with inflation risk. Now, When we put together retirement income plans for clients, we're always modeling the impact of inflation. So if they say to us, well, I need $65,000 a year in basic expenses, cash flow coming in after tax, that's fine, but then we're going to have to inflation adjust that $65,000 every year at 2 or 3% to kind of cope with inflation. So I'll give you some basic examples. So let's say you've got somebody who's retiring today and they need an after-tax income of $58,000. And the number we're using specifically is $58,121. Now, at 2% inflation between now and the next 25 years, that 2% inflation will reduce the purchasing power from just over $58,000 to an inflation purchasing power of $35,427. If inflation averaged 3%, the purchasing power will go from $58,000 to $27,759. And if the inflation rate averaged 4%, the purchasing power would go from just over $58,000 to $21,802. So more than halving, 50% reduction in purchasing power. So again, you can cope with the impact of inflation, first of all, by building a financial plan that models the impact, and then trying to confirm what kind of return you need to get from your portfolio, or how much you need to save in total, so you can cope with that incremental 2 to 3% increase in cost of living every single year. So before you retire, you need to build those models so that you know you can defend yourself against the impact of retirement. And that's a combination of how much you spend and how much you think you're going to get as a return on your portfolio and what you think the inflation rate is going to be. And you might want to use different models to kind of game what the impacts would be to see how bulletproof your retirement income planning is. Now, the fourth factor is really important, and that's withdrawal rates. Now, again, when we develop retirement income plans, we use a sophisticated modeling software that shows the impact of producing a constant rate of income over time when you take into account company-sponsored pension plans, Canada Pension Plan, Old Age Security. We wrap all that into their portfolio, and we decide, based on the model, how much we need to be taking out from the portfolio to supplement those basic pensions. So that's really important to do. But if you want a starting point, generally most models will tell you that if you want your portfolio to last out to life expectancy, you don't want to have overall withdrawal rates of much more than 4%. So that 4% of your portfolio to 3% of your portfolio pretty much guarantees that the withdrawal rates will be not too large to impact your portfolio so that the goose that lays the golden egg is dead and gone long before you are. So withdrawal rates are really important. If you use a 4% withdrawal rate to a 3% withdrawal rate, and the idea there is whatever that 4% is, then you can increase that by the rate of inflation, then you're probably in pretty reasonable territory in terms of your overall planning if you don't go much more above that withdrawal rate. Now again, withdrawals have to be nuanced. Sometimes people have income that's not kicking in for a few years when they retire, so they might put more pressure on their investment portfolio in the early years, and then they'll have some additional pensions kicking into them. So one good example is people with Canada Pension Plan benefits or Old Age Security. If they retire early, before age 65, they might have to put pressure on their investments until those other pensions begin to kick in for them. And then the last area that needs to be factored into your retirement income plan is healthcare costs. So for many people, healthcare costs are going to go up over time. That's just a truism when it comes to longevity and retirement. There's a few things you can do even before you get to the money side to try to reduce those costs. So one of the best ways of planning, it's not financial directly, although it costs money to eat well, but you want to make sure you watch your diet, you get regular exercise, you try to reduce stress levels where you can, and you just live a healthy lifestyle. And the more you do that, the more you can reduce the potential that long-term health costs are going to be spiraling out of control for you. So that's just one practical thing that we all can do when it comes to our own personal planning in this area. Now, the kinds of costs that you would incur, I'll just give you some basic numbers. Long-term care home has a potential, depending on subsidies, anywhere from $21,000 to $31,000 a year. A retirement home might be in the range of $15,000 and above. You could be looking at costs of daycare programs of $18,000 a year. Private home care can be very expensive. The costs really go up. So really what I do when I work with clients on the long-term care, which tends to take place at the latter stages of the retirement journey, is we try to make sure the clients do not have to use home equity as an example or real estate equity to fund their retirement. So if you have a principal residence, you may end up selling that home in your late 70s or early 80s. You might transition into a retirement residence, and now you've monetized the value of that home equity. As long as you don't put too much pressure on that equity, that money is there to pay for those higher expenses for long-term care or retirement residences in the latter stages of your life. So those large expenses, if they come in the last 2 or 3 or 4 years of your life, which is typically the case with these expenses, then by having the real estate and principal residence value still there, it allows you to cope more effectively with those increased costs. So those are the 5 factors that I wanted to review with you. Make sure your financial plan deals with the impacts of longevity risk, that you have an asset allocation strategy that matches where you are in your retirement journey, more growth when you're younger, balances you getting close to retirement, and then begin to build income wedges and safe harbor assets in your portfolio when you begin to take income. Make sure you model inflationary impacts. Make sure you don't get too aggressive with your withdrawal rates from your portfolio when you retire, and take into account how are you going to deal with healthcare costs as you get older. So again, if you're not a subscriber, make sure you hit the subscribe button so you don't miss any future content. As well, we have links in the notes to this video. So if you want to get information about a retirement coaching service, there's information there to a link. You can get to our website. There's also a way of reaching out to us if you'd like to start a conversation about our retirement income planning services. Anyway, wishing you all the best in your retirement and wealth planning journey. You take care.